SoFi's biggest problem is the topic of today's presentation. If you're somebody that's holding SoFi stock, you ought to be able to explain what it is they do. Now, what we've found is that becomes very difficult when you start digging into the details. Now, on the tin, it seems pretty simple. So SoFi's mission is to help their members, who they define as high earners not well served, to help these individuals achieve financial independence to realize their ambitions. Now, when you read that mission and then you look at what SoFi actually does, those are contradictory statements. And also what's interesting is to evaluate this label of high earners not well served. The not well served component of that refers to the millennials, more or less, and that generation that expects their banking services to be easy to access and available from their mobile phone. So SoFi doesn't have any branches. Now, we looked at SoFi. This was just over a year ago, and this piece titled, "Is SoFi Stock a Ticking Time Bomb? Hard to Tell." And the interesting part of that article looked at how sophisticated SoFi was, but the intro was quite funny. So this email that you see here on the left is typical of the sorts of emails that we get every day. Lots of Chinese firms emailing us for no reason at all, asking us if we want samples of things. And here is a email from Rambo Zhu, and you may think his first name's quite funny, but that's very typical in China for people to select whatever names they like. I had a colleague that had a coffee and a lettuce in his office, and both those girls were very sweet and had no idea that the names they chose for themselves were food. So a cursory look at the SoFi 10Q showed us a convoluted business, and we said we'd be more likely to buy a pallet of EMI shielding fabric from Rambo than we would buy shares of SoFi. So since then, those shares have risen 26% versus a NASDAQ rise of 22% over the same time frame. So that puts the recent surge in SoFi shares into perspective. They're more or less just catching up. Now, SoFi is based in San Francisco. They refer to what they do as social finance, and this statement about positive social and environmental impact. Well, they're a bank, and what we look for when we look at a bank is their banking services and how well those benefit us. That's ultimately what we care about. Now, they were initially known for their student loan refinancing business, and they've since expanded into all kinds of things: personal loans, credit cards, mortgages, investment accounts. They're aiming to be a one-stop shop for personal finance, and they focus on the Henry's high earner, not rich yet. As we said, mobile only, no physical locations. Now, when you start to dig into the details, it becomes very convoluted very quickly. So here's an example of how they label things in a relatively confusing manner. So they refer to, on the left here, as something referred to as products, and there's $8.5 billion worth of products in Q1 of 2023. What are those? Well, look at the tables here on the right. On the top there you see total lending products, and on the bottom you see total financial services products. And if you add those two things together, it gives you the number on the left. What do those numbers mean? Really, nothing. So do they imply that personal loans are just 11% of the business? Yes, if you do the math, but not if we look at revenue. So how does SoFi make their money? They can provide these labels about products all they want and try to quantify things that seem very odd to quantify in that manner, but what it comes down to is where they make their money from. Here you can see a revenue breakdown. There's really a couple things to note here. That lending is where most of their money comes from, and you can see that financial services component has jumped significantly between the first quarter of 2022 and the first quarter of 2023. Now, when we look at lending, this is where we believe the biggest problem for SoFi lies. Personal loans account for 64% of their total loans, and it's their fastest growing loan segment. With lending at 67% of total revenue, that means 43% of their revenues are coming from personal loans. That's not something we want exposure to for reasons that we discussed in our recent piece on Affirm and also Upstart. So nearly 2/3 of their total revenue is from unsecured loans. That's a big red flag. So another thing to note here is when you see that their FICO scores are dropping. Now, this was based on the last analysis that we did that said their FICO scores were dropping for home loans and for personal loans, but not for student loans. And that's something that you should keep an eye on, because what happens is when they try to keep that growth, then the problem there is that they're having to reduce their threshold and take lower and lower FICO scores in order to keep that growth going. Now, when we look at lending risks, SoFi currently holds $6.8 billion in personal loans on their balance sheet. They designate these loans as held for sale, but are increasingly holding them longer. And what's happening here is they're trying to find institutional investors or banks to buy these loans. That's what held for sale means, but the demand for that is drying up. So SoFi hedges the bulk of these loans through interest rate swaps, which opens up counterparty risk. Now, the question here is, can this biggest problem that SoFi has, their heavy reliance on unsecured debt, can this be diversified away internally? Sure. So there are other two segments we can look at aside from lending. One is their technology platform, and we've briefly described it here, Galileo and Apex. So Galileo acts as an API for other fintech companies to use. And then you have Apex, which is a sort of clearinghouse. That's their technology platform component in revenues. Then you have financial services. This is what we saw growing so quickly, and it refers to SoFi general banking services, their investing and financial planning services, their personal finance management app called Relay, also their advisory fees on ETFs. And of course, there's a cross-selling element to this. Customer opens a checking account and becomes a potential lead for a loan, for example. Now, when you look at the way that they're describing financial services here, it starts to become rather confusing. And in our next piece, what we're going to do is take a look at where the revenue growth is coming from to make financial services grow that quickly. And we're going to dig deeper into each one of these components along with the technology platform. Now, you need to remember that SoFi's strategy is to be a one-stop shop, and there's a lot of competition. In mobile banking, you have Chime, Goldman Sachs and Marcus, Apple working with Goldman Sachs, Ally, Discover, and Lending. You have Upstart. We've covered them recently. We also talked about Lending Club in that same piece. And you have financial services, Mint, Investing, Robinhood, a firm that also says it's doing good for its clients, and it's absolutely not. So when you issue that many unsecured loans to people who you're trying to make financially independent, that's a conflict of interest. And SoFi offering cryptocurrency would be another conflict of interest when you talk about helping people build wealth. So the problem that we see with this firm, aside from that heavy reliance on unsecured loans, is that there's many external stakeholders that create risk. You have the American consumer acting financially irresponsible. You have institutional buyers who are drying up, who may not be buying the loan bundles from SoFi at the same frequency as they did in the past. You have the lenders who lend money to SoFi, so then SoFi can lend it to the American consumer. You have counterparty risk for the other side of SoFi's billions of dollars worth of interest rate swaps. You have the government that can enact certain laws on student loans that can affect SoFi, and of course the Reddit meme stock types who appear to be boosting the shares at the moment, who just sit around on their YouTube channel focusing on one firm and doing nothing but cheerleading it all day. That doesn't help serious investors. So just to conclude, we find there are too many external risks for SoFi, and it's too complex of a business. We've barely scratched the surface on this. The majority of the revenues are coming from unsecured loans, and that would be student loans and unsecured loans, personal loans. Keeping those loans on the balance sheet is a big risk. So is the counterparty risk they take on when they engage in swaps. Now, the ample competition out there is also going to drive down growth and or margins for SoFi. We're avoiding the stock for now. In our next video, we're going to look at the other two segments outside of lending. So I put up another video here that you might be interested in, but before you click that, please click the logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.